I can't lie, I'm a bit disappointed with the market's reaction to the CPI report this morning. The chefs out back gave us the perfect month-over-month read, the 0.5% as expected. However, the year-over-year came in at a miss, 0.2 of a percentage point, yet the market remains unchanged. And you would have expected, without a material decline in inflation, the market should have responded negatively to that. It simply did not. So it just continues to reinforce the idea that sellers are currently not present in this market, or at least they're not doing a very good job of stepping up and making themselves known. Overall, the daily chart remains mostly unchanged, as we pointed out. A little bit of an upper wick here to read into. We're going to walk through the charts quite briefly tonight and update you tomorrow with the full comprehensive breakdown. So for now, large upper wick on the daily bar, large lower wick on the daily bar, small body in between. Of course, indecisive doji here, not really telling us a whole lot about confidence of the market. If we think about location on the bar-to-bar count, yes, we did make a higher high, but notice that we closed back inside of Monday's range, not all that confident in holding prices at those higher levels. On the lows, we technically made a higher low, but it's not, not significant. It's not a significant higher low. What is important about this bar, though, is the fact that we continue to hold on to that pivot level on the SPY at 410, and we know that we're in an overall uptrend. We talked about this on Sunday night with continued higher lows being placed on the daily time frame chart. We're now just looking for that equal high up around 416.75. If we have a look at the hourly time frame chart, you can clearly see how even on the liquidation break from the morning volatility, buyers step in, defend SPY 410, the top of the prior single prints from the FOMC rally here, and we hold up for an hourly higher low. We have lows and now higher lows. The next objective of this chart would be to break the resistance trend line here and get the daily equal high at 416.75. So currently not seeing any evidence of stronger sellers. Once again, they had their opportunity here. We technically, very nuanced, but we technically closed that hourly bar underneath 410 and even look underneath on the subsequent hourly bar, right? Let's read into this structure just a bit. We break down underneath the red bar's low, set the next low, and then close back inside of the red body bar. To me, that's a big failure from the sellers to keep prices underneath that 410 area, even after breaking that prior hourly bar's low. The market internals also show us a pretty bullish edge here. Notice the volume inflows on Monday get close to significant, around 300 million, and on today's session, even with that liquidation break, hold positive. The overall inflows for the week are positive as well, as reflected from the cumulative build. If you look at the advanced decliner, you can certainly see some more positive action here into the close of business on Monday. And on today's session, a strong rebound here. The liquidation break finds a higher low, and we close around the zero line. So it's not the best day on today's session, but it's certainly not as bad as it could have been. We didn't even spend any time down below into trend zone underneath 1500. Looking at the cumulative builds on the tick, strong read on Monday, reinforcing the momentum there. And on today's session, notice on the liquidation break, once again, the strong sell side move that came after the first initial reaction higher. The ticks do get negative here. You're getting some negative impressions around that negative 1000 mark, but the cumulative build never really gets down below negative 2000. It doesn't pick up that momentum in the downward direction. So once again, sellers not all that strong in this current market. When taking a look at the market profile, we might need to slow down just a little bit on the bullish edge. The main reason being is that the value area here, although it is centralized in the overall range of today's session, the point of control is definitively lower than the Monday point of control from here to here. Now, what's interesting about this is that we have a big spike, so to speak, at the top of today's range, and this mechanical level here that I would expect, if broken, could lead to a breakout into the remainder of the week. So I'd keep close eyes on about 41.57 into the remainder of the week. If we can crack that area, these B prints should not really provide too much resistance. I would imagine that would lead to higher outcomes in your S&P. But once again, with the lower point of control, it may make sense to dial back the bullish narrative and say, hey, maybe we're in store for a little bit of consolidation or even sideways action, because we still know that we're awaiting the retail sales data as well as PPI on Thursday. There's good excess at today's lows. Not a whole lot to say about Monday either. It is a classic P-shaped profile, so we would assume that most of it was short covering early on in the session. Then we go sideways and build out value higher. A quick glance at the sector's performance for the week so far definitely reveals more of a risk-on attitude, with the XLY at the top of the list here up 2.69%. followed by tech up 1.77% and communications, big rebound from last week, up 0.96% so far. At the bottom of the barrel, we're certainly seeing the XLRE for real estate, consumer staples, and then utilities lagging the markets, which is exactly what we want to see from a risk-on posturing perspective. Taking a look at the structural charts, notice that the XLY found a beautiful higher low here, well above the top, or not well above, but literally right at the top of the prior range. At 148, it did not need to come back in and test this gap, so we want to watch for continued bullish outcomes to hold 148 into the future. Anything sideways up here strikes me as bullish and healthy. The concern would be obviously on a breakdown of 148 into the remainder of the week. Let's have a look at the XLK continuing to hold up in its balance range up at the top now after that beautiful hammer candle that we pointed out in the Sunday night video. Watching for a break of these highs right around 143.50 to start to work our way towards that gap overhead. Certainly looks more bullish than bearish for our markets, and once again only becomes a concern at least intra-week if we break down underneath 139.25, but still a daily opportunity for a higher low off of 135. Next up is the XLC for communications. A little bit of a rebound here. Once again, not even coming into this area. Strikes me as a healthy look for finding a daily higher low coming off of this big higher high. Seems reasonable as of right now. We want to watch for what the reaction is back through the overhead gap range. So over 56 starts to get interesting. Can we retrace the thin structure from the breakdown all the way back to 58? That's the next question. And then when and if we get here, that's where we really don't want to see a daily lower high, right? This would start to become a concern. So keeping an eye on communications as we move forward, but so far the daily structure here does look solid. Notice hammer candle looks underneath the prior day's low, closes strong at the highs, two equal highs, breakout point, right? So watching 56 in communications. Financials up next. A little bit of a look above and fail. It didn't really get much acceptance above the prior two wicks that you see from here and here. So we're still willing to give this one the benefit of the doubt and not call it the look above and fail just yet. Want to see that continued price action over 37 with some momentum and with some strength. And honestly, with the CPI coming in slightly hotter than expectations, being an indication that the Fed might be a little bit more hawkish, supporting higher rates, which is generally good for financials. I'm kind of surprised that this didn't outperform, and tech actually was green on the day's session, more so than the XLF here. So anyways, as long as it stays above 36, continuing to be a bullish to neutral force, breaking down underneath 36 bears, as we pointed out on Sunday, you need the lower high confirmation underneath. Until then, it's just neutral or bearish. Next up, we've got the XLB for materials, kind of sideways up here in the overall range that we've experienced. Not really worth reading into until we get a breakdown underneath 80.75 or back above 84.25. Next up, we've got industrials, 8%, putting in a beautiful ascending triangle, something that's starting to look like this. Nice hammer candle on today's session. We would say the same comments about the lower wick undercutting the prior day's low and closing strong back up towards the top of the range. Watching for breakouts over 103, targets 105.25. That, of course, would be a bullish force for your S&P 500 energy. Inside bars galore, right? So here's that range that we talked about on Sunday. There's the midpoint. There's the gap and go from Friday. Just going sideways, not outperforming, not getting any traction above these prior highs. We want to see it continue to go sideways in this overall box. Once again, only a concern from a defensive perspective if we start making new highs over 93.25. Next up, XLV, healthcare sector, starting to get a little bit of upward momentum on the Monday session, but promptly reversing on today's session. Notice that it did not, though, get all the way back down towards these lows on a breakdown of the prior day's lows. So it's not bullish. Let's be very clear about that. It's not bullish here in the XLV, but it's certainly not as bearish as it could be. And the main thing to keep watching is, do we get acceptance, continued acceptance on the other side of this trail, on the bullish side? If so, you know the deal. We're probably looking for a move into 137.15, which certainly helps keep the S&P afloat, being the second heaviest weighted sector of the S&P. Next up, XLU for utilities, D for defensive. We want to see it going sideways. That's exactly what it's done here. Let's leave it at that. Next up, real estate sector, much more to do with the wealth effect, not so much on the day-to-day. Going sideways here, as long as it's holding up, decent, neutral for your S&P. Really much more of a concern underneath 37.25, not a threat at this point in time. Last but not least, consumer staples, just like utilities, this is a D for defensive sector. We want to see it going sideways, lagging the market. It's exactly what it's doing here in this sideways box. If this is going to turn into a double bottom, that's fine. Price acceptance over 74 is not the end of the world. You're just looking for this to lag the market. You don't want it to be breaking these highs as the S&P is attempting another leg higher on this rally. Some quick comments from the ratio grid. XLK is continuing to look absolutely phenomenal, making a new high in the ratio. XLV is still sideways above its double bottom bottom neckline, but certainly threatening a move back down underneath. Once again, we'll come back down to that daily time frame trend line we just discussed. XLF wants to see more continuation over this on the breach of 37. We discussed that on the structural chart, and XLY continuing to consolidate sideways, even perking up towards the top of its flag range here in the ratio. Overall, the top 4 risk-on sectors definitely look more bullish than bearish as a group. Certainly some concerns here, but we know about those structural charts. In terms of the bottom 4, the risk-off sectors, has any big improvements been made in the upward direction here? And the answer has to be no. XLP is actually rotating back lower. XLU actually rotating back lower. Energy starting to flatten out from this uptick that it saw here. And the real estate sector also rolling over a bit, but once again, having much more to do with the wealth effect. So it's not as strong of a risk-on look that we've seen in some of the past instances where this was fully perked up, where this was starting to rebound higher, or even in here in the early stages. And this, of course, has been a concern for a little while now, but still really great strength in the XLY. It's hard to say that it's a full-blown risk-off look. It might be starting to get a little bit more neutral, but overall, hard to say risk-off. Having a look at our dollar, you'll certainly notice that it's still stuck in the bull flag consolidation, and we even put in a hammer candle on today's session. The concern about this chart is the fact that it could potentially, on a breakout, stop the phenomenon of daily lower highs, keeping us in a downtrend, and any recaptures of really 105, you have to start to question whether or not the dollar is going to find a new uptrend, which in theory should technically put some downward pressure on our equities. In terms of the TNX and what's going on here, no surprise to see it up slightly on the miss from the year-over-year readings in CPI. We'll continue to monitor this, specifically around PPI coming out on Thursday, 8:30. Be prepared for that. But from a technical perspective, right, we talked about this as a double bottom breakout. If this is going to turn into a weekly double bottom breakout, all eyes need to be still on 38.80. So watching that. If you're a market bull, you really want to see TNX remain underneath that level here, or even better, breaking down underneath 34.30. As of right now, with the economic data that came out today, doesn't look like the breakdown case here in the TNX, which would be bullish for equities, is really at the forefront of the market's mind. Instead, I think we want to see what the reaction is around 3.8 in the 10-year. In terms of bonds, you'll notice that the relative strength line continues to break down here. No flight to safety to speak of as of right now, which is noteworthy considering that the TNX did move higher today and your S&Ps kind of held in there sideways. So even after today's CPI report missing on the year-over-year readings, you're not noticing any difference in the Fed tracker tool from when we updated you on Sunday, which I think is kind of perplexing. I would have figured with the miss on the year-over-year, we would have increased odds of a 50 basis point rate hike, even if it was slightly so, and decreased odds of a 25. But regardless, strong opportunity, or really the market's pricing in almost with like 90% certainty, a 25 basis point rate hike in the month of March. Regardless, we know Jerome Powell has been pretty consistent in his messaging in saying that rates will have to get up and over 5%, which makes sense considering that we're seeing a 6.4 on the year-over-year reads, when just last month we had a 6.5. So there was no real progress made in deflation really setting in. I think we're kind of stagnating here, and that's the fear of the market. In terms of month-over-month readings that are worth noting, anecdotally, we pointed out how gasoline prices at the pump were increasing. You saw that in your 2.4 in the month-over-month for the category of gasoline. Fuel oil was deflationary. What else was deflationary here? We see used cars and trucks coming in a little bit, and then down at the very bottom, you're getting medical care services coming in slightly as well. A big driver of inflation that Jerome Powell continues to note is our housing, which is here, shelter, still up 0.7 on the month-over-month read. So not really ideal. This number wants to get down, 0.2, 0.1, those types of readings to really stabilize and feel more comfortable for the total inflation rate. And Jerome Powell has been very clear about that possibly being something to watch out for in the second half of 2023. So the market pricing in more of a hawkish stance upcoming from Powell seems reasonable based on today's report. We'll learn more tomorrow on the retail sales report, and then Thursday from the PPI report. Having a look at the VIX, you'll certainly notice that we're back down underneath that 2050 area, which was prior support, and support through here, turning it into resistance and turning it into resistance. From a technical perspective, the more time we spend underneath 2050, the stronger this chart looks as a signal that, hey, markets are content with this bottom. This seems to be a reasonable higher low pullback. There's even the opportunity for some continuation at this point in time. If the VIX perks back up over 2050, that would certainly be cause for concern that says, hey, things are starting to get shaky again. Watch out for some downside, or at least the potential for some downside to increase. Maybe that will happen on the PPI, and maybe that will happen on the retail sales numbers, but as of right now, definitely more comfortable from a volatility perspective. And one of the concerns that we had in the Sunday video was that the VVIX was diverging from the VIX and really elevated here, meaning that somebody was taking a downside hedge in the markets. And once again, remember that this simply represents someone made the hedge. It does not guarantee that the market will see an adverse reaction. So to see this coming back down, once again, starts to confirm that comfort talk or comfort look we just had on the VIX talk. There we are. In terms of Contango versus backwardation, strong move in the downside direction from the front versus back month contracts here inside of volatility. So once again, money managers more comfortable allocating capital today versus waiting for some unknown time in the future. Speaks to improved bullish odds over time in the market. Q's held a beautiful higher low above 296.50, also above the technical close of the single prints. We've got a recapture of 302.75 as well. A key difference here is notice that the close of Tuesday's bar is well above the close and high of Monday's bar. It strikes me as more of a sign of strength, noting that the tech component of the market is usually an indication of risk on and a significant driver of upward momentum. So to me, more bullish than bearish, obviously a strong opportunity for an equal high to be made up around 311.75. I don't think we're going here this week, but if retail sales come in perfectly, if PPI comes in perfectly, 320.50 is the next overhead level to have. Notice that it's almost a 2, maybe even 3 sigma move outside of the weekly expected move as priced in from the options market. Wouldn't be my first thought that we go there, but again, maybe just put it on your radar. For bears to get any traction here, it's got to be a breakdown of 296.50 and then a lower high underneath 300, turning this newfound higher low support here into resistance. Doesn't seem like a high probability outcome unless PPI and retail sales are an absolute disaster. Structurally, we've got some pretty solid footing underneath us. Next up, we've got the IWM Russell 2000 and the small caps. We'll keep it brief here. Notice the equal high closures. So unlike the QQQ there, it's more similar to the S&P, but we do have the strong response off of our prior structural element, off of 188.90, and a rotation in the upward direction. Upper edge of the weekly expected move is the prior structural resistance, prior support and resistance in that upper wick at 196. That would not be an equal high. Note the difference there. An equal high is much higher at 199, well outside of this week's expected move. So IWM could say, hey, we'll get here and then reevaluate things. The big concern would be if this turns into a daily lower high without making the equal high first at 199. Something like this could be cause for concern on a double top. But once again, I would just remind you that it's not a double top until it is a double top, aka breaking down underneath the neckline of the pattern, this prior structural element that, we've got so much market interaction around. I don't think the bears are going to have an easy time necessarily breaking down through it if this pattern plays out in the first place. But as of right now, things are looking solid, and we are, just like everything else, watching and monitoring for upside continuation, noting that we've got a strong daily trend with lows, higher lows, newfound higher lows, and we're pulling back off of a higher high. So instead of going through all of the core list of companies, I'm just going to share a couple of charts I found noteworthy. The first one is GOOGL. Notice that we've got a strong pin bar on today's session, classic hammer candle setting up, but the reason it's so significant is because prior to this hammer, we had all of this bear flag consolidation, finally got the flush of those lows at 94, and there's absolutely no follow through from the sellers. Instead, we've closed back inside of that consolidation range. So watching today's high, if we can get a higher low setup over 95, should be back off to the races through the thin structure for a retest of 99.50. When and if we get here, we are no longer bullish, noting that there's a strong possibility on the daily time frame chart to build out some sort of head and shoulders type pattern. I would watch 99.50 for a lower high when and if we get here, but nonetheless, the hammer candle strikes me as noteworthy for today's session. Next up, we have Microsoft. The pattern is really most evident on the hourly time frame chart, but notice the daily gap held. So Monday we get the gap and go. On today's intraday volatility, CPI, all of that nonsense, beautiful inside bar in the upper half, I would roughly say, or upper 2/3 of the Monday range. So just note where these levels are coming from. The gap underneath us is held. It's a sign of strength from the buyers, and this overhead gap will become the target on a break of 274. If we go on down to the hourly time frame chart, Notice the higher lows on the hourly chart here, here, and here. And of course, we have a clean breakout point at 274. If that break happens, once again, the daily target is 280, 250. Very clear pattern, strong sign of strength on the gap and go from Monday. Last but not least is C3AI. Now, I have to preface this by saying it has been a parabolic runner with all this AI nonsense in the headlines. So be aware that whenever you get something that looks like this, it can be very easy to just say, oh, it's going to do it again. It's going to be a parabolic runner. It could go ahead and go to zero. Let's just make up an imaginary situation where it comes out, they actually don't have a generative model. They don't have the licensing. They don't have whatever. The stock goes to zero. Guess what? So does your position if you're long. So manage your risk by trading something like this via position size. If you're buying calls, if you're buying puts, you can only lose the premium that you buy. If you sell options on something like this, you're opening yourself up to a whole lot of risk. Wouldn't be my first choice. The reason that this made the cut today is because we technically open on a gap down. So a little bit of a lower wick here, but where do we close? Up above the prior red bar's high. This is all happening as well, mind you, on an increase in volume. So could another parabolic leg be around the corner? It's a possibility, but once again, hedge your bet by sizing the position for zero. If this doesn't materialize, you should not be losing your shirt on this particular trade. That's all I've got for you on today's session of the impromptu midweek market update for the special CPI report. If you appreciate the video or learned anything new, let me know down below in the comments section, and I wish you all a green trading week.